Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, and we're going to be looking at the social risk and showing how retail investors never returned like they did in the last cycle, at least not yet. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. And of course, you can get access to the charts like the ones that you'll see in this video. The social risk is a way that we use to measure social interest in crypto. Obviously, there are times where it feels like everyone's getting interested in crypto, and it makes people call for alt season. And it can feel like it did in 2021. But there's the perception of reality and reality. And those can be two very different things. The social risk is the orange line that you see on this chart. It is made up of 5 different risk metrics. The first one, of course, is subscribers to various YouTube channels, views to those various crypto YouTube channels, followers to various analysts on X, formerly Twitter, followers to exchanges on X, and new followers to layer 1s on X. When you take all 5 of these metrics and combine them, you get a metric that looks like this. You can see that in 2017, 2018, the social risk went above 0.8, and ultimately that was the top. You can also see in 2021, it even went above 0.9 risk, back when everyone was essentially stuck at home and they were printing money like crazy, and everyone was tuning in to the Cryptoverse. What you will notice, despite what it has felt like at times, retail interest never actually returned in the same way that it did in 2021, at least not yet. At least not yet. And the interesting thing about it, right, you can even apply a moving average to this to kind of clean it up some. What you'll notice, and I've been sort of adamant about this for a long time, is that this whole phase right here just seems like what happened in 2019, right? When retail interest sort of returned, but it never really quite returned in the same way that it did later in 2020 and 2021. And so when I look at this cycle, what I think is, all right, it looks like this phase right here, right? It looks like this phase right there. And then I remind myself, well, why does it look like that phase right there, right? Why does it look like that? And the best answer that I can come up with, and of course this should come as no surprise to anyone, but the best answer that I can come up with is that monetary policy is more similar to 2019 this entire time, right? This entire time than it is 2020 and 2021. We had only 3 rate cuts in 2019. We've only had 4 rate cuts or so this business cycle. We also were in quantitative tightening throughout this entire period that led social risk lower, that led social interest lower. If you look at a metric that I really like looking at, the advanced decline index of the top 100 cryptocurrencies, does it look like this ever entered a durable uptrend this cycle? No, it's been dropping since November 2021. Altcoins have been bleeding to Bitcoin since November 2021, really sooner than that. But we're not going to get into that in this video. This is not a Bitcoin dominance video. Although really, they're all Bitcoin dominance videos. What it looks like is this period when the ADI, the advanced decline index of the top 100 cryptocurrencies, was also dropping. And it did not start going up until well after interest rate cuts and quantitative tightening was over and quantitative easing began. So this part of the cycle looks like this part of the cycle. This part over here, where the advanced decline index of the top 100 cryptocurrencies going up, never occurred, or it hasn't occurred yet, because monetary policy never sufficiently changed. Now, You might say, well, hold on a second, Ben. The Fed did cut rates by 100 basis points. And last cycle, they only cut by 75 basis points before the ADI started going up. And you'd be right. But the difference this cycle is the terminal rate. The terminal rate last cycle was only 250 basis points. This cycle, it was 550. And 75 over 250 is a greater ratio than 100 over 550. In order for those to be equivalent, from memory, I believe you would need 165 basis points of rate cuts this cycle to mirror what happened last cycle, which would mean another 65 basis points of rate cuts, so another 2 to 3 25 basis point rate cuts to get there. That could explain why the advanced decline index of the top 100 cryptocurrencies keeps dropping. That could explain why the social risk keeps dropping. The social risk right now is 0.009. There are literally dozens of us left at this point. The people that are here now are probably the people that are going to be here no matter what, right? That's my guess, right? If you're still here now, you'll probably stick around no matter what, because not really a whole lot's happened in the last few years as far as the altcoin market goes. Yes, Bitcoin has gone up, but the social risk does not really track Bitcoin. If we're being honest, it tracks the altcoin market. In fact, we're overlaying here the price of Bitcoin with the social risk, and you can see they kind of diverge a lot. Overlay it with the price of Ethereum. And what you'll notice is that actually maybe matches a little bit better. And I've often said Ethereum is sort of like the index of the altcoin market. If it's doing poorly, just interest in crypto is not that high. And altcoins aren't really doing that great. And you can see that as Ethereum has collapsed here, so too did the social risk. So when we talk about the social interest in crypto and it being low, what it means is that altcoins will likely keep bleeding to Bitcoin. And now you might say, well, don't prices have to go up for social interest to go up? That's true, but Bitcoin's been going up for a long time, right? And social interest never really returned. In order for it to take off like this, the altcoin market has to join the party. It can't just be Bitcoin. Because in 2019, when it was just Bitcoin, social risk only went up to the 0.3 to 0.4 risk level. It didn't really go that high. Just like this cycle, it hasn't really gone that high. Now, I know a lot of you guys are going to be like, well, why aren't you tracking Instagram? Or why aren't you tracking TikTok? And why aren't you tracking this? Why aren't you tracking that? I'm not. I don't know. Maybe I will at some point. I'm not right now. To me, I think this has done a pretty good job of capturing it, because despite everyone's proclamations that I'm missing what's going on over on TikTok, altcoins keep bleeding back to Bitcoin. So I would argue that I'm not missing much, right? Because if I were, it would be captured in the fact that altcoins would be going up against Bitcoin if retail were truly coming back. But because they're not, altcoins keep dropping against Bitcoin. So, to give you an idea of what each of these metrics look like when you don't just look at a risk metric calibrated, you can look at, say, a 7-day moving average of views to various crypto YouTube channels. And you can see how this cycle, there's been several tries, or there's been several times when the views to these various YouTube channels will sort of go around that 2 million or so. But it's never sustained. Like, anytime it spikes to 2 million, it just comes back down, right? It happened in March of 2025. It happened in March 2024. It also happened in December of 2024. It also happened in November of 2022 and in May of 2022. But every time the social risk spikes 2 million, it isn't sustained. And the reason it's not sustained is because every time it does it, that ends up marking a pivot point for Bitcoin for a while. And people tune back into the Cryptoverse when volatility occurs. When volatility goes away, people start to tune out. And right now, these crypto YouTube channels are only averaging 700,000 views a day. That might sound like a lot, but when you look at 2021 and see that they were regularly averaging 2 to 3 million views a day with a spike to 4 million, it's proof that retail interest never truly returned like it was at least here in 2021. You can look at subscribers to those crypto YouTube channels and see that while there have been a few spikes to 20,000 new subscribers per day to these crypto YouTube channels collectively, last cycle in 2021, we saw them spike to 40,000 and even as high as 60,000. And it was a more durable spike, right? Like we stayed at higher levels longer. This time we haven't. If you look at followers to various analysts on Twitter, what you'll notice is that we are well away from what happened in 2021. We've only seen occasional spikes up to around 20,000 new followers a day collectively for these various Twitter accounts. But in 2021, we saw a spike to over 100,000 in a single day. And there was a huge base where all of these accounts were averaging 25,000 or more together followers per day. This time, we've only seen a couple of spikes to those levels, whereas in 2021, that was the base. And it was higher than that, really. The base was higher than that. So, and you can also look at exchanges on Twitter and followers to those exchanges and see how much lower it is this cycle compared to last cycle. You can look at a 30-day moving average of it and just see, like if you took calculus, back in either high school or if you took it in college, you think about like the area under the curve, right? The area under this curve here is much greater than the area under it over here. There's not nearly as much interest today as there was back then. And you can also look at Twitter followers to layer ones on Twitter or X and also see that it's kind of like kind of the same as the others, where it pales in comparison to what we saw last cycle. It pales in comparison. Now you might say, well, is it because people aren't tweeting as much? But that's not actually true. People have still been tweeting and posting on Twitter, right? It's not like they're not getting followers because they're not posting anymore. They're posting on average, let's take a 30-day moving average of tweets by these same crypto accounts. On average, they're tweeting about the same, if not more. There was a single spike in 2021 where it went higher, but for the most part, these accounts are averaging more tweets per day than in 2021. So it's not because these accounts are tweeting less. It's because altcoins keep bleeding to Bitcoin. And despite what everyone says, that Bitcoin is king, which it is, but despite what people say, they truly want alt season. That's what they want. And because they keep not getting it, alts keep bleeding to Bitcoin. Well, sorry, let me say that again. Because altcoins keep bleeding back to Bitcoin, they lose interest. And because they lose interest, the social risk goes down, which means Bitcoin dominance goes up. So in order to see this change, you need monetary policy to change, which can ultimately lead to people getting more interested in the asset class. But we haven't reached that point. And a lot of people keep saying that it's going to happen, right? They said that, quantitative tightening was going to end over and over and over again, and that they were never going to raise rates this high, and that if they did, they would completely break everything, and that wasn't true, and they kept rates at 5.5% for a long time. The stock market kept pushing new all-time highs. And now, after all this time, what you'll notice is that despite everything, the social interest has stayed low, despite everyone freaking out and calling for alt season, and Bitcoin dominance has gone higher. The only way you're going to see that change is monetary policy change. And the way you get monetary policy change is you get pain in the markets. We are getting pain in the markets right now, right? We've seen a lot of pain in the markets. And the more pain that the markets get, the higher the chance that looser monetary policy comes. But in order to see change, you have to have the pain. Welcome to the pain. I don't know how long the pain is going to last, but it's this type of pain in the markets that you see persist over a long time that then leads to changes in monetary policy. Now, obviously, right now, Bitcoin's back up. It's near $93,000, $94,000. Obviously, that's been a big improvement. Still, the social risk hasn't really changed. Why is that? Because altcoins still aren't really doing anything. And the social risk goes up when altcoins go up with looser monetary policy. Loose monetary policy comes into play with pain in the market. We're in the pain now. So those are my thoughts. Those are the reasons. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.